Welcome back to the channel, traders, investors, and financial explorers. Today, we are embarking on a monumental journey into the minds of the most successful speculators in history. We are diving into a book that is universally considered the holy text of the trading industry. We are talking about Market Wizards by Jack D. Schwager. If you have ever wondered what separates the elite professionals who pull millions of dollars out of the markets from the average retail trader who struggles to break even, this video will reveal those exact secrets. We are going to explore the psychological frameworks, the risk management strategies, and the personal stories of the greatest traders of our time. Grab a notebook, get comfortable, and let us dissect the strategies of the market wizards. The quest for trading greatness. Jack D. Schwager set out on a mission to answer a single burning question. Is trading success a result of pure luck, or is there a definable skill that can be learned and replicated? To find the answer, he traveled across the country to interview traders who had achieved unbelievable returns. We are talking about individuals who turned a few $1,000s into hundreds of millions. Schwager interviewed commodity traders, stock pickers, options experts, and global macro speculators. What he discovered fundamentally changed the financial world. He found that despite their wildly different methodologies, these elite operators all shared a specific set of core beliefs and habits. Some of them used highly complex mathematical algorithms. Others relied entirely on fundamental economic data. A few simply looked at the price action on a chart. Yet beneath these surface-level differences, they all possessed an unwavering discipline and a profound understanding of risk. This book is not about giving you a secret indicator or a magical formula. It is about rewiring your brain to think like a professional risk manager. Michael Marcus and the power of holding winners. Our story begins with Michael Marcus, a man who turned $30,000 into $80 million over a 10-year period. But Marcus did not start out as a genius. In fact, his early career was defined by constant failure. He wiped out his account multiple times because he lacked discipline and relied on the tips of others. His turning point came when he met another legendary trader, Ed Seykota, who taught him the absolute necessity of trend following and cutting losses. The most important lesson Marcus shares is the concept of patience. He explains that the biggest mistake average traders make is taking small profits too early, while letting their losing trades run in the hope that they will bounce back. Marcus completely inverted this habit. He teaches that you have to hold on to your winning positions for dear life. You have to let the trend carry you as far as it possibly can. He suggests that you should only trade when you have a combination of technical, fundamental, and market tone confirmations. When all three align, you take the trade and let the market do the heavy lifting. Marcus also stresses that trading requires courage. You have to be willing to take a position when everyone else is terrified, and you have to have the mental fortitude to sit on your hands and do nothing when the market conditions are not optimal. Bruce Kovner and the Global Macro Chessboard. Next, we explore the mind of Bruce Kovner, one of the most intellectually brilliant global macro traders in history. Kovner approached the markets like a giant game of international chess. He did not just look at price charts, he studied global politics, central bank policies, and economic supply chains. He believed that to make massive profits, you have to understand the fundamental forces that drive global wealth. Kovner teaches us that fundamental analysis and technical analysis are not enemies. In fact, they are perfect partners. He used fundamental analysis to figure out what the market should be doing, and he used technical analysis to figure out when to enter the trade. If he believed a currency was fundamentally undervalued, he would wait for the technical chart to show a breakout before risking his capital. His absolute strict rule, however, was risk management. Kovner never entered a trade without knowing exactly where he was going to place his stop loss. He placed his stops at levels that, if reached, would prove his fundamental thesis completely wrong. By doing this, he removed all emotion from the exit process. He accepted that he would be wrong, often, but his losses were always small, while his fundamental trends provided massive career-making victories. Richard Dennis and the Turtle Experiment. One of the most fascinating stories in the entire book revolves around Richard Dennis, Known as the Prince of the Pit, Dennis turned a borrowed $400 into an estimated $200 million. But his greatest legacy is a famous bet he made with his partner, William Eckhart. Dennis believed that trading was a teachable skill. Eckhart believed it was an innate talent. To settle the debate, they placed an advertisement in the newspaper, hired a group of ordinary people, and taught them a specific trend-following system. They called this group the Turtles. The Turtle experiment was a massive success, proving Dennis right. The system he taught them was incredibly simple. They bought breakouts of high prices and sold breakdowns of low prices. But the magic of the Turtle system was not the entry. It was the mathematics of risk management. Dennis taught them to calculate the volatility of every single market they traded and to size their positions accordingly. If a market was highly volatile, they traded a smaller position. If a market was quiet, they traded a larger position. This ensured that their risk was constantly equalized across their entire portfolio. The ultimate lesson from Richard Dennis is that you do not need a complex strategy to make millions. You need a simple, mathematically sound system and the iron discipline to follow it without deviation, even during periods of massive drawdown. Paul Tudor Jones and the Art of Defense. When it comes to spectacular returns in high-energy trading, Paul Tudor Jones is a titan. He famously predicted the Black Monday stock market crash of 1987 and made a fortune while the rest of the financial world was losing billions. But despite his aggressive reputation, Jones reveals that his entire philosophy is based on playing relentless defense. Jones teaches that the most important rule of trading is protecting your capital at all costs. He constantly thinks about what he can lose, not what he can make. He uses a concept called time stops. If he enters a trade and the market does not immediately move in his expected direction, he simply exits the position. He refuses to wait around and hope. Furthermore, Jones relies heavily on historical chart patterns and market mechanics. He believes that markets are driven by human emotion, and because human nature never changes, price patterns repeat themselves over decades. He teaches us that you must never play the hero. If the market is moving against you, you cut the cord. You can always re-enter the market tomorrow, provided you have preserved your capital today. Ed Seykota and the Psychology of Systems. Perhaps the most enigmatic and profound figure in the book is Ed Seykota. Seykota was a pioneer in computerized trend-following systems. He wrote algorithms on punch cards in the 1970s that generated mind-boggling returns. But surprisingly, his interview with Schwager focuses very little on computers and almost entirely on human psychology. Seykota drops one of the most famous pieces of wisdom in the entire trading industry. He states that everybody gets exactly what they want out of the market. This means that if you are constantly losing money, it is because, on a subconscious level, you actually want to lose. Perhaps you want the thrill of the gamble, or perhaps you want the sympathy of your friends when you share your tragic trading stories. Seykota forces traders to take complete ownership of their results. He emphasizes that a trading system is only as good as the psychology of the trader executing it. If a trader cannot handle the emotional pain of a drawdown, they will inevitably abandon their system right before it becomes profitable. He teaches that you must align your trading methodology with your own personality. If you cannot sleep at night, your positions are too large, or your system does not match your risk tolerance. Larry Hite and the Mathematics of Risk. Larry Hite approaches the market with the cold, calculated precision of an insurance actuary. Hite founded Mint Investment Management, which became one of the largest commodity trading advisory firms in the world. His entire philosophy is built on the absolute respect for risk and the understanding of probabilities. Hite realized early in his career that he could not predict the future. And more importantly, he decided that he did not need to predict the future to make money. He built automated systems that followed long-term trends, but his true genius was his strict adherence to risk control. Hite never risked more than 1% of his total equity on any single trade. By keeping his risk infinitesimally small, he ensured that no single market event, no matter how catastrophic, could put him out of business. He viewed trading purely as a numbers game. If you have a system that wins slightly more, Often it loses, and you strictly control your downside risk. Wealth accumulation becomes a mathematical certainty over time. Hite teaches us that survival is the ultimate metric of a trader. If you do not lose all your chips, the mathematical edge of your system will eventually make you rich. Marty Schwartz and the transition to independence. Marty Schwartz provides a fantastic story of personal transformation. For years, Schwartz was a frustrated fundamental analyst who lost money consistently. He tried to trade based on what he thought the market should do rather than what the market was actually doing. His breakthrough occurred when he abandoned fundamental analysis completely and embraced technical analysis. He transformed himself into a day trader, focusing entirely on price action, moving averages, and market timing. Schwartz became a champion trader by developing an intense, almost obsessive work ethic. He spent hours every single evening analyzing his charts and preparing for the next day. He teaches that trading is not a casual hobby. It is a highly competitive sport. You have to be more prepared than the person on the other side of the trade. Schwartz also highlights the danger of ego. He explains that his early failures were due to his inability to admit he was wrong. Once he learned to separate his self-worth from his trading positions, he became incredibly agile. He could take a loss, reverse his position, and make money in the opposite direction without hesitation. His story proves that you can reinvent yourself as a trader if you are willing to abandon the dogmas that are holding you back. William O'Neill and the Study of Winners. Moving away from the futures and commodities markets, Schwager interviews William O'Neill, a legend in the world of equity investing. O'Neill founded this publication, Investors Business Daily, and developed the famous CAN-SLIM trading methodology. His approach to the stock market is entirely empirical. He studied the greatest winning stocks of the past century to find out what characteristics they all shared right before they made their massive upward moves. O'Neill teaches that human nature makes retail investors do exactly the wrong things. Average investors love to buy stocks that have crashed because they look cheap, and they are terrified of buying stocks that are making new highs because they seem too expensive. O'Neill proves through data that the exact opposite is true. The stocks that make the most money are the ones that are already showing massive relative strength, reporting explosive earnings growth, and breaking out of long consolidation bases into new high territory. He teaches traders to only buy the absolute best companies in the strongest market sectors, and to ruthlessly cut any stock that drops 7 to 8% below the purchase price. O'Neill represents the perfect blend of fundamental earnings analysis and technical price action. James B. Rogers and the Fundamental Purist. James B. Rogers, who co-founded the Quantum Fund with George Soros, provides a stark contrast to the technical traders in the book. Rogers is a fundamental purist. He does not care about head and shoulders patterns or moving average crossovers. He cares about global supply and demand. He travels the world, reads historical texts, and looks for massive macroeconomic imbalances that the rest of the market has ignored. Rogers teaches that the greatest opportunities in the market happen when there is a massive shift in a country or an industry that nobody else believes in yet. He looks for extreme situations of oversupply or extreme shortages. When he finds a situation where the fundamentals are overwhelmingly in his favor, he takes a position and holds it for years. However, Rogers also offers a very stern warning to retail traders. He believes that most people trade way too often. He advises that you should literally do nothing until a setup appears that is so obvious and so heavily skewed in your favor that it feels like picking up money off the floor. His strategy is the epitome of extreme patience followed by massive conviction. Dr. Van K. Tharp and the Psychology of Success. Jack D. Schwager understood that interviewing only traders would leave a gap in his research. To truly understand the mental framework of the elite, he interviewed Dr. Van K. Tharp, a research psychologist who dedicated his career to studying the behavioral traits of winning and losing traders. Tharp synthesizes many of the lessons learned from the wizards into a cohesive psychological blueprint. Dr. Tharp explains that most people fail because they are searching for the holy grail of trading systems. They think that if they just find the right indicator, they will be rich. Tharp reveals that the holy grail is actually inside the trader. It is the ability to manage risk, control emotions, and develop a system that fits your personal psychological makeup. He emphasizes the concept of expectancy, which is a mathematical formula that tells you how much money you can expect to make on average per trade. He teaches that a trader with a 50% win rate can make a fortune if their winners are 3 times larger than their losers. Tharp reinforces that discipline, self-awareness, and total responsibility are the ultimate tools of the trade. If you cannot manage your own state of mind, you cannot manage a trading portfolio. Synthesizing the wisdom of the wizards. As we look back over the collective wisdom of these incredible individuals, a very clear picture emerges. Trading success is absolutely not about predicting the future. None of these wizards claim to possess a crystal ball. They all experience losing trades, and they all go through difficult periods of drawdown. What separates them from the masses is how they handle the uncertainty of the market. First, they all have a defined methodology. Whether it is a fundamental macro view or a computerized trend-following system, they have a strict set of rules that dictate exactly when they enter the market. They do not trade based on gut feelings, rumors, or desperation. Second, they possess supreme discipline. Having a system is useless if you do not follow it. The wizards execute their plans flawlessly, regardless of how terrified or euphoric they feel. Third, and perhaps most importantly, they are all obsessed with risk management. Every single wizard interviewed by Schwager emphasized that capital preservation is the absolute priority. They cut their losses quickly, brutally, and without emotion. They understand that living to trade another day is the only way to allow their edge to play out over the long term. Finally, they exhibit total psychological independence. They do not care what the financial news networks are saying. They do not care what other traders are doing. They trust their own research, their own systems, and their own ability to navigate the ever-changing tides of global capital. Final thoughts and application. Market Wizards is not just a book to be read. It is a manual to be studied and internalized. The lessons contained within its pages have the power to completely transform your approach to the financial markets. But reading about discipline is very different from practicing discipline when real money is on that line. Your challenge now is to take these principles and apply them to your own trading journey. Stop searching for the perfect entry signal. Start focusing on your position sizing, your stop-loss placement, and your mental state. Accept that losses are simply the business expenses of trading. Find a methodology that makes sense to you, backtest it rigorously, and then commit to executing it with the cold, detached precision of a professional. The market is an unforgiving teacher, but if you adopt the mindset of the wizards, it can also be the greatest vehicle for financial independence ever created.